what is the stock market index or indices? It is also known as the benchmarks of the markets. And in this video, we're going to show you how they are constructed and also do some simulation on the sum of the calculations done for the market index. So now, if you go into some sources or website, what you can see is that very commonly you can see the websites, they always display the indexes and they quote the prices of these indices. And very commonly you always see Dow Jones and S&P are actually appearing most of the time. So not just on one source, you can see it in Bloomberg, CNBC, all right, CNBC, and also in your smartphone. All right, so if you put all of them together, these major market indices, their prices usually move in tandem. All right, so that means if they go up, for instance, they go up together, and if they come down together. So this is what we call the move in sympathy. All right, some people call it correlation. All right, but of course, no, we just say that it moves in tandem. All right, so we don't actually overthink what is happening behind. So now let's say, for instance, how is Dow Jones constructed? So Dow Jones comprises about 9 sectors, and it has 30 companies included inside the Dow Jones index. So here are the major top 10 companies. You have Apple, Microsoft, Visa, JP Morgan, Johnson Johnson, Walmart, then the biggest healthcare company, United Health, Procter & Gamble, Walt Disney, and Home Depot. So of course, you can see these 2 technology companies are the largest in market cap. So that takes around about 20% of the weightage in the Dow Jones index. So second, what we can see here is that we can see 2 huge companies in financial sectors, which takes up about around 16.7%, then followed by consumer staples and healthcare. So all right. Now let's move to another index, which is S&P 500. So how it is constructed? So it is divided in 11 sectors, and it has about 505 large cap companies technically. And the smallest company in this S&P 500 index is about 4 billion in market cap. So currently in NYSE, it has about 8,000 stocks listed as of June 2021. So what you can see here again, you can see information technology has the biggest weightage. Then second is healthcare. Then consumer discretionary. So it's a bit different, slightly different compared to Dow Jones. Dow Jones has financials in the second place. Now, how this S&P is calculated? So it's based on what we call S&P is a float adjusted market cap weighted. So how it is done is, if we look at the calculation, to calculate S&P index, we have to use the sum of the current market cap divided by the sum of the base market cap. And here is factored by 10. It's because it's to make it more reportable or manageable, all right here. So sorry, it is factored by 10 right here. Now, for example, I'm just using 5 companies to actually to represent an index right here. So summation of 5 companies, and let's say, for instance, we would always need to take the base price against the current market price, which means with the current floating shares, right? With the current floating shares multiplied by base price, you get base market cap. And with the current floating shares multiplied by the current price, you get the current market cap. Now, what is base price? So base price is when the a stock is listed in the market, is where they have started, in the early days, where they have just listed. So they are considered very low price compared to now, the current price. So this is just an example. It's not necessarily the real price that is calculated. So what I intend to do here is that to show you the concept on how the index is calculated. So now, if you take the sum of current market cap which is right here, altogether, which is a sum into this, and versus the sum of base market cap. So which is all of these market cap of these five companies sum into this one. All right. So current market cap, sum of current market cap divided by base market cap, we get 10. So the thing is that 10 is too small. So last time what they did, they have to multiply with a bigger number to make it um, easier to be actually reported. All right, the numbers is just for the simple purpose. All right, so imagine they were if it's very small, then this will in very small decimal numbers reported in maybe 0.01. All right, so that doesn't look very good. So they have to multiply that, and the index might start around like 100 right here. So right now, okay, you might be wondering why I'm actually mentioning that why this is used based on floating shares. Why not outstanding shares? So what's the difference between floating shares and outstanding shares? So this is actually to give more transparency into this equation. The equation right here is that if we look at outstanding shares, it's just a display of a total ownership before breaking it down. And you know that most individual insiders or the controlling shareholders we call it, they don't usually sell their shares. So in let's say for example this is in Apple company, so they're actually in a very small portion right here, right? So if you take them out and you take the entire shares of all these different shareholders, public institutions, and you have state government owning this, and some private companies. So if we take the floating shares, it's almost about 99%, right, of the total outstanding shares. So these are like the more active shares that are to be actively traded, right? What is not actively traded are the individual insider shares. So they are always in there for the long term. Right, so now let's get back to this calculation right here. So with all these five companies considered as an index altogether, so we have generated the pie here because all of them have different market caps. Definitely they will have different weightage in the index. So now here's how it works. Now if we go to an Excel spreadsheet, so for instance, now let's say the index is around 100, right? The price is at 100 right now. So now let's say for instance, if you have a price change in Apple, let's say for instance about 10 or not 10%, let's say, all right, so okay, for instance, let's say 10% for instance, then it will be 143. All right, so once it changed to 143, you could see the percentage change of the index is about 5%. All right, 5% by just increasing 10% in Apple. So that's a huge change in the index. Right, most of the time the index, overall index in the market changes maybe 1 or 0.5% or 1%. All right, so right now let's go back to about 130 originally priced. Now let's go to a smaller company like a Chevron or Western Digital. Now let's say Western Digital, it has increased the price about even it has increased the price of about 50%, which means it's about let's see 105. So let's say increase of 50%. How much does it cost? I mean, impacts the index. So it only impacts about 0.8% right here. So it's not a lot compared to Apple. So we take the two extremes right here in this case. Now let's say, for instance, again, we undo that, and Chevron, you see the share price is very huge, right? 5,000 right here, but it has very little floating shares, and it gives this company also So it's slightly almost the same as this Western Digital, right? Western Digital right here, 42,000, 50,000. So again, if the share price doubles, let's say for instance, 100% change, double. So it only changes 1.15%. All right, but if Apple or Microsoft changes about 50% or even less, 20%, what happens? So if it changes 20%, let's say this is 235. So it changes 8% of the index. So what I'm saying here is that the bigger the market cap, like Microsoft and Apple, a small change in price percentage will impact more on the index. So okay, here you go. So what we call this is, in short, we call it capitalization weighted index. But of course, originally it's quite a mouthful. It's called float adjusted market cap weighted. Right. So I wouldn't go further than this. So we just want to keep it basic. And I'm pretty sure with all this explanation, you'll get an idea how the market index works. So I'll thank you for your time and happy trading and investing. Striker X here, signing out.